But what we've seen people do in this industry that is very destructive for them is they just put their head in the sand, head in the sand, and they don't do anything until the situation gets even worse. And each day you're doing that, your equity is getting eaten away in your home by penalties and fees. And then if they take your house and sell it on the courthouse steps, you are not going to get as much for that house as if you put it out on the market.
Hello, and welcome to Real Loan Talk, the podcast where we unlock the secrets of creative financing and real estate. Hosted by Sonia Morgan from S.J. Morgan Private Lending Exchange. This show is your go-to source for expert advice on mortgages and real estate investments. Whether you're buying your first home, managing your investment portfolio, or considering a reverse mortgage, Sonia's insight will guide you through the process. Get ready to learn, grow, and achieve your financial goals. Let's dive in to today's episode.
Hello, and welcome today to Real Loan Talk with Sonia Morgan. And we're going to have some actually real loan talk today. I don't have a guest, but there is a topic that I really believe we need to start talking about. And that is a lot of the foreclosures that are going on in our market right now. And I have seen quite a few of them because I'm in private money, and people have a tendency to call me to see what do I have to do? How can you help me? And I want to go over a specific situation that I am seeing more of recently. And that is borrowers who were in a loan with a very low interest rate. So back in the time of COVID, people were refinancing their homes and getting just extremely low interest rates, so 2% and 3%. And these borrowers then, during COVID, when they lost their jobs or something went wrong for them, they listened to what the government said and to what everybody was saying around them and stopped making their payments on the house. And they took what was called a forbearance. So what that really means is that they said, I can't make my payment now. I'm going to go ahead and make my payment later. And when the later time came around to make the payment, the banks basically have said, your payment's due. It's 100% due now. So you went 3 months, 6 months, 9 months, whatever it was without making a payment. And now it's due, all of it. So you owe us $12,000, $20,000. And the borrowers were like, well, I can't pay. So what happens when you go into a forbearance where you're not making payments and the bank has agreed it's okay for a while, you don't have to make your payments, and they've agreed with that. And so you've taken their agreement and now you're allowing that forbearance to go on, but it comes to an end and they're like, we need all of our funds. The next step is something called a modification. So what a modification means is that you're modifying that loan. And so one of the main things that they're modifying is they're going to maybe push the date out that the loan is due to cover the period of time that you didn't make payments, or they're going to take whatever amount you owe them and add it to the end of the loan as a modification. And that's what was happening a lot after COVID. That's what most people were doing. They were doing these loan modifications after their forbearance. And then people kind of got in this habit of, I don't make my payment, the bank just does a modification, we move on with life. And that's kind of what was happening. But recently, people have been once again going into forbearances, and the banks have agreed to it. They've said, fine, you can miss a few payments, we'll put you in forbearance. And then when they've come back around to do the modification, the bank requalifies them. And there's something in the mortgage industry called the ability to repay. And this came after the Frank-Dodd Act because they needed to make sure that people could make the payment on their mortgage. And so if you go to qualify for a mortgage loan, we as the loan officers have to make sure that you can make the payment. And so the same thing happens with the modification. Well, what happened for a lot of people is that whatever the situation was when they got into the loan is different than it is now. So maybe their insurance prices went up, or maybe they weren't retired. Maybe they got the loan when they had a job and now they're retired and they don't qualify with the ability to repay to pay that loan anymore. And the bank is like, sorry, we're not going to modify your note. So what does that mean for you as the homeowner? Well, that means you have to catch up or your note is going into foreclosure. And a lot of people don't have the $20,000 or $30,000 just to take out now and catch up where they were at. And the banks, I feel, are sort of strategically doing this. So I don't want to talk bad about banks because I am in the business of lending money from banks, and I need banks to continue my business, and I think banks are great, and they do a great job for a lot of people. But in this case, I think that they're making a strategic move to get these low interest loans off their books. And so what they're doing is they are calling these notes, they're not modifying, people are not qualifying with ability to repay, and they're just like, sorry. So what we have now is somebody who has a considerable amount of equity in their home. So let's say their house is worth $600,000 and they owe $250,000, but they're behind in payments like $20,000. So what are they supposed to do? They're going to have to go into foreclosure. They're going to foreclose on you, and you're trying to find anybody that will lend you the money. Well, here's the real loan talk. Nobody is going to lend you the money. Nobody's going to lend you the money because you're in a forbearance, you're behind, you're in a default on your mortgage currently. And I hate to say this, there's not a product out there right now that can suit you or satisfy you. I'm getting a lot of phone calls because I'm in private money or hard money, whatever you want to call that. And people think, hey, like this is my last stop place. You should be able to rescue me. And we actually don't do things like this. They're considered bailout loans. And what we mean by that is that you may be moving along perfectly in your life and you're having a hard time making this payment, then you come to myself or another private money lender to get a bailout loan. And what we're going to do is end up with something more expensive even for you. It's going to be a more expensive loan. And so it's going to make your life even more difficult. And that's not our desire. And our desire isn't for one of our investors to fund your loan and then you go into foreclosure. So, with us, and we don't want that either. So unfortunately, we do not have a solution to help you with that loan. So then what can you do? What is the answer? So I'm sure that there's several answers out there, but I want to give you one possible scenario today that might be a good scenario for you if you're somebody who's found yourself in the situation of not being able to modify, owing a lot, being in foreclosure, not being able to get a loan from anybody to help you catch up. Prepare yourself because this is going to be some real talk. This is not going to sound like something you want to do, and it may not even sound pleasant to you. But my suggestion is that you sell your home. If you have equity, you be in charge of the sale. Put your house on the market. Let the bank know that you've put the house on the market. They'll give you some extra time typically. It's not a promise, but they're typically going to give you time to get your house sold, sell your home, and rent for a while, save that money, and re-enter the housing market at a later date. You may even be able to re-enter the housing market much quicker, depending on how bad your credit is and how much equity you have. But there will not be a product that will help you stay in that home that I'm aware of at the moment. So there may be other people that could help you with that. I know last time the market crashed back in the early 2000s or 2008, 9 through 13-ish, there were a lot of companies that came out that were helping people do this modification on their homes, and they were charging people a lot of money, and the banks have gotten much smarter about it now, and that's not a product that's available, mostly because there's a lot of equity in people's homes, and they're just expecting that you're going to sell your home and that they're going to get this 2% loan off their books. So if you're in this situation and you have questions, you want to know what would a takeout loan look like if I were to sell my property, would I be able to move into another property, then you'll need to call a loan officer. Preferably, I don't know what area you're in, we're licensed in California, preferably a loan officer that deals with creative financing that can do what we call non-qualified mortgages, non-QM loans, to help you find something for you. So I don't want you to feel discouraged. I mean, the really good news is that you have a house and you have equity. The bad news is that it's difficult to move, and there's a very real possibility that you'll need to move. But what we've seen people do in this industry that is very destructive for them is they just put their head in the sand, head in the sand, and they don't do anything until the situation gets even worse. And each day you're doing that, your equity is getting eaten away in your home by penalties and fees. And then if they take your house and sell it on the courthouse steps, you are not going to get as much for that house as if you put it out on the market. And if it does go to the courthouse steps and you owe $250,000 and they sell it for $350,000 at the courthouse steps, you will get the remainder. You will still get the equity between what you owe the bank or your lenders and how much it's sold for. But if you sold it out on the market with a realtor, it most likely would sell for more than it's going to sell on the courthouse steps. And so if you don't do something and you just wait, there's a good chance you're just throwing money away, and you don't want to do that. So even though I know it's an answer that you don't want to have, I just really feel like I need to tell people that, because they keep coming to me and probably other creative lending people to get a solution that is not quite there yet. So if a solution does come out, I will be the first to tell everybody, hey, there's a new solution. This is a lot of times when there's a new challenge in our market, solutions come out for that challenge. But so far I haven't seen any. And historically, there haven't been any solutions for somebody who's in a forbearance and has not been able to modify. So if you have any questions, do feel free to reach out to me. You can put some questions below, and I'd be happy to answer them. If you want me to speak in more depth on what a foreclosure process is all about and how that works with the lender, let me know, and I'll be happy to do that too. So I know it's a lot more fun when we have people on here and we're doing a podcast and we're talking about fun things, but this is just a real topic that I believe that we needed to cover at this moment in time. So thank you so much for tuning in today and listening to Sonia Morgan with SJ Morgan and Real Loan Talk with Sonia. I appreciate you all.
Thank you for joining us on Real Loan Talk, hosted by Sonia Morgan. We hope you enjoyed today's episode and found the information valuable. If you have any questions or suggestions for future episodes, please reach out to us. Be sure to subscribe and leave a review on your favorite podcast platform. For more detailed resources, visit our website at sjmorganple.com. You can also follow us on social media and explore our podcast website at realloantalk.com. Until next time, stay informed, stay inspired, and let's achieve your financial dreams together.